See the desktop?
Yes, sir.
Okay. Okay. I hope that you can hear me clearly, right? Can you hear me?
Yes, sir.
Yes, sir.
So actually today I'm going to assign you the second case study and also going to continue my discussion on uh, the next topic, and because we have already completed the time value of money discussion. Okay, I hope that you can hear me, right? Can you hear me?
Yes, sir.
Yes, sir.
Because I was getting some notification from Zoom that I am signed out or something like that. Anyway, as soon as you can listen, it's okay. And the meeting is recording, right?
Yes, sir.
So what about the class representative? Any class representative attending the class today? Hmm?
Excuse me, sir.
Yeah.
Can
Any
you?
class? Yeah. Who is the class representative of this class?
Govind, Varshita, and I are the class representatives.
Okay. So what is your name?
Umar.
Omar. So I told you something to do in the last class.
Yeah, I the attendance was with the Govind. I asked him to share. He said he'll share with you. If not,
But
I'll share just now, sir.
yeah, please share it with me by
Yes.
email. Send me by email. I didn't receive it yet. Okay. So before starting the next discussion, let me assign you the second case study. Actually, I am going to assign a very easy case study this time because so that you get a bit relief, or let me create a balance between a relatively complex one with a relatively easier one. Hmm. So you can see the Excel file, right? Now, can you see the Word file?
Yes, sir.
So this is the case study, and you'll be very happy to see that it is a very easy one. So all the instructions remain the same. This is on the time value of money, almost same. You should read all the instruction. The group members are also the same. And then the case is only a very simple one, but you have to do it very carefully so that you do not commit any mistake. In the spreadsheet, it is not going to be 4 line. In the spreadsheet, it is going to be quite long. So what you need to do, you need to create a loan amortization schedule in the spreadsheet. So what is the thing? You need to take a bank loan amounting $10,000 for a new investment in an equipment, and the bank charges annual 9% interest on the loan. The loan must be repaid in monthly equal installments, okay, in a 3-year period. So the duration of the loan is 3 year, right? And you have to repay the loan in monthly equal installment. Now, what you need to do, you need to establish the loan amortization schedule for the loan, just like what we have done in the last class and the previous class. Okay, so follow the demonstration that has been given in the last class and also in the previous class. And I have already given you the link to the class recording. Have you received that? Have you received that?
Yes, sir.
Okay, so follow that one and you will be able to do it. And the submission instruction is just like before. You have to submit two files. One is the spreadsheet file and another one is the attendance file as before. And the deadline is November 18. That means the coming Thursday. So you are getting about almost 1 week time. And this is quite easy. Even 3 days should be enough. Anyway, so you have to submit by November 18 without any exception. And your demonstration or presentation, like before, it will happen on November 19 and November 26. Okay, if I call your name and if you're not there, then that is counted as you cannot answer or something like that. Okay, so that is all. This file will be shared in our WhatsApp group, and also I will send to the class representative. You are sending me the attendance, so in reply, I will send you this document and make sure that it is distributed to all the students. Is that okay, Omar?
Yes, sir.
Okay. Any question about the case study? No question. Okay. Thank you. So let us go back to our discussion. If we look at the syllabus, then we have already done up to time value of money. Now we are going to start the discussion of cost of capital. Okay, cost of capital and capital budgeting. So at first we'll discuss how to estimate the cost of capital in a spreadsheet software. But before doing that, we need to have our concept clear. What is actually cost of capital? What is actually cost of capital? That needs to be clear to us. So to make it clear, I'm opening a notebook file so that I can show you what is actually cost of capital. So it is about cost of capital. So how is the weather in your area? Is it getting colder or warmer? How is the weather in your area?
Cool, sir.
Cool. Temperature? In my area, it is about 20 degrees Celsius or something like that. So what about your area?
Yes, sir. Minimum 20, maximum 24.
Similar. So we're going to discuss about cost of capital, right? You know that if you want to become a business manager, then you need capital. Am I right or wrong? Do you need capital for doing a business?
Yes, sir.
For doing business, for doing business, what do you need? You need capital. So where do you get this capital? You might get this capital from two types of sources. It can be either from borrowing, okay, or from what? Or from, can you tell me from where? Any idea? No problem if it is a wrong answer.
Sir, loans. Loan from bank.
Loan from bank. That is also borrowing, actually. Yeah.
Sir, savings, investments, savings.
Savings of the owner, right?
Yes,
Savings
sir.
of the business owner himself or herself, right or wrong?
Yes, sir.
Okay. So the personal savings of the owner, that means the owner's money, actually. So that means it is actually the owner's investment. You have already done accounting, right? Have you done accounting courses? So this one is called debt, and this one is called equity. So if you borrow the money from the bank, or if you if you borrow money from your relative or from your friend, whatever is the case, if you borrow the money, that means if you take the money in condition that you will return the money with some interest, then it is called debt. Okay, it is called debt or borrowing or loan, same thing. But if you take the money as an investment, so that the investor, from whom you take the money for your business, the investor also becomes an owner. Okay, then we call it equity. Do you get that? Sometimes we 3 or 4 friends can start a business. Okay, and when they start a business using their own money, we say that they are collectively the owners of the business. Okay, and sometimes we also say that they are the shareholders of the business. Am I right or wrong? Is it new to you, or you know already? Is it something new to you? The problem of taking your classes, you do not respond. That is probably the cultural difference. Anyway. So we can see that there are two sources of capital. One is the debt and another one is the equity, right? So you should think that you should be able to recall that no capital is actually free. If you take the debt, then there is no free debt. The bank is not going to lend you money for free. And again, if you get the money from the owner, that means if you yourself is the owner, you are not investing the money for free. Actually, you are expecting some return in future, expecting some profit in future. So that is the cost. And if you invite other people to become the owner of the business, they are also not going to invest in the business without the expectation of getting more profit in future. Okay, so you have to fulfill the expectation. If you fail to fulfill, then probably they are not going to invest in another time in your business. Okay, so whatever is the case, if you take the debt, that is also costly. If you take the equity, that is also costly. So we are talking about the cost of debt as well as the cost of equity. Okay, so cost of debt means how much cost you have to bear for borrowing money. Okay, and cost of equity means how much cost you have to bear for getting the owner's investment. Okay, so collectively these two are called cost of capital. Collectively these two are called the cost of capital. Now, why do we need to think about cost of capital? We need to think about cost of capital because you have to compare, okay, compare the cost with the profit or return. Otherwise, you cannot make decision. For example, let's say you have taken money from a bank, you have taken loan from a bank, and the bank is charging you 10% interest. So that is like the cost of debt. Cost of debt. Okay, that is like the cost of debt. Now, that is like the cost of debt. So if you invest, let's say you have taken $1,000 loan from the bank at 10% cost, 10% interest rate. Now, what you need to do, you need to invest this money in a new business, or probably in a new product, or probably in a new market, a new market where you have not sold before, or probably you invest this money to buy new type of product to sell it at a higher price. So whatever is the case, should you be happy by getting 8% profit from the new business? If your capital costs 10%, what should be the minimum profit that you must earn? What should be the minimum profit?
11, sir.
Yeah, it should be more than 10%. Otherwise, there is no point of doing the business. Okay, it must be more than 10%. So you can see that in making a business decision, we need to compare the possible return with the cost of the capital. So if you really want to do that, you have to know how to measure the cost of capital, how to measure the cost of capital, how to measure the cost of debt, and how to measure the cost of equity. You need to understand, you need to learn. So this is what we are going to do in this class, actually. Get it? Okay. So the cost of debt, how to estimate the cost of debt. So for understanding that, we will give an example of bond. Do you have any idea what is a bond? Any idea what is a bond? If you have no idea, then tell me that we don't have any idea.
No, sir.
No. Okay. Any idea about share? Any idea about share? What is a share of a company? Actually, the share and bond, these are the different types of, one type of bond is a type of debt, and share is a type of equity. Nothing new, actually. Just now I have said that if 5 of your friends start a business using their own investment, and then we say that all these 5 friends are the owners of the business. In other words, we can also say that these five friends are the shareholders of the business. Okay, so from there we get the word share. Share means the percentage of ownership. Okay, percentage of ownership of a business. So if you have the share of a company, that means you have invested certain amount of money in the company as an owner. And there are many owners like you who also have invested in that company, and they are also the shareholder. They also have the share of the company. But by bond, what we mean is, we mean that you have, in case of bond, you also invest some money, but not as an owner, rather as a creditor. So you are taking the role of a bank, actually. So in case of bond, let's say you have bought $1,000 bond. Okay, you have bought $1,000 bond. So what does it mean? It means that you have given a credit of $1,000 to the company. Okay, so you have given a $1,000 credit to the company if you are the bondholder, just like the shareholder. If you are the bondholder, then you have given a credit of $1,000, a loan of $1,000 to the company. So what will happen? Definitely a bond mention the maturity. So if it is a 5-year bond, that means after 5 year, what will happen? After 5 year, the company will return this money because they have taken it as a loan. So loan must be returned. Am I right or wrong? To you. Am I right or wrong?
Yes, sir.
Company must return this $1,000 after 5 years. Not only that, during this 5-year period, the company will give you interest. Payment. Maybe every year or every 6 months, depending on the contract between the bondholder and the company issuing the bond. Okay, so have you understood what is a bond and what is a share? Have you understood?
Yes, sir.
Okay.
Yes, sir.
Okay, great. So if you have understood, then let us talk about the cost of debt, how to calculate the cost of debt. So cost of debt is not only the interest rate that we have mentioned here. We have mentioned about the interest rate here, right? Where is that? The interest payment. Let's say the interest rate is 11%. Okay, so this is not really the cost of this is the main component of the cost of debt, but this is not the only part of the cost of debt, because when a company issue bond, it has to it has some legal expenses, some documentation expenses, some marketing expense, because they have to promote the bond in the market. Okay, so these are called flotation costs. So what are the components of cost of debt? Number one, the coupon interest payment. Okay, this interest payment is well known as coupon interest payment. This is another name. Okay, so coupon interest payment, this is one component of the cost of the debt. Then there is another, which one is the cost related to issuing the bond. Okay, cost related to issuing the bond. So when a company wants to issue the bond, they have to market it, they have to promote the bond to the investors, that we are issuing this bond and we are a very good company. You will be benefited by investing in this bond, this kind of thing. So that is some kind of selling expenses. And they also hire a kind of broker. We call them underwriter. Okay, underwriter. So underwriter will also take some commission for selling the bond, and they will also have to apply for permission to the regulatory authority of the country. Okay, so so that they are allowed to issue the bond. So that will also involve some legal expenses. They will have to submit different documents, so documentation expenses. So all these things are called the issuance cost or flotation cost. Okay, flotation cost. So that is another cost of the bond. And you'll be happy to know that not all things are negative. There is also a positive thing. When a company issues a bond, the company also gets some interest tax benefit. Interest tax benefit. So what kind of benefit is that? Can you see my screen, my writing?
Yes, sir.
Okay, so interest tax benefit. What is actually interest tax benefit? The interest tax benefit is the reduction of tax because you are showing interest expense in the income statement, which we could not have shown if there were no bond. If there is no bond, then you cannot show the interest expense, and your tax will not reduce because your profit will be higher. But if you have a bond or bank loan, then you can show interest expense as an extra expense that will reduce your taxable income, taxable profit. So if your taxable profit reduces, then you have to pay less tax. So that is the interest tax benefit. So we have to combine these three things in the cost of debt calculation. Okay, we have to combine these three things in the cost of debt calculation. But we will not do it on the pen and paper, rather we will do it in the Excel. So how to do that? Let us go back to the Excel worksheet. So let us write down a hypothetical example. Okay, let us write down a hypothetical example. Probably you can see the Excel worksheet, right?
Yes, sir.
Okay. So let us write down a hypothetical example. Let's say, in case of bond, we have several things. One is the face value of the bond. So look at what I'm doing very carefully, because after a while I will ask you to do all this thing so that we can have a practice right in the classroom. Okay. So face value of the bond, we are giving a notation F, and normally the face value of a bond is 1,000. In US perspective, it is $1,000. So we are not making any exception. 1,000. Okay. This is the face value of the bond. We also need another thing that is called price of the bond. Remember that the price of the bond might not necessarily be equal to the face value of the bond. The bond has an official value which is needed to calculate the coupon interest payment, and also to make sure how much money the bondholder get after the bond mature. That means at the end of the bond life. Okay, so that is the contractual value of the bond, $1,000. But market price is not depending on the contractual value. It will depend on what? It will depend on the demand and supply for the bond. Okay, so the market price of the bond is also important, will be needed in our calculation. Okay, market price of the bond. Market price of the, what happened? My keyboard is betraying. Market price of the bond. P for market price. Okay, let's say the bond has a high demand because more people wants to buy it than the people wants to sell it. Okay, so in that case, the market price of the bond will be higher or lower. What does your common sense say? What do you think? If more people are interested to buy the bond, so what will happen? That will increase the demand or decrease the demand?
Increase the demand, sir.
Okay, so if it increases the demand, then what will happen? The market price will increase. It will be more than, probably more than the face value. Okay, so let's assume that the market price is 1,150. Okay, have you understood? Now we have also said coupon rate, coupon interest rate or coupon rate, same thing. So that is the contractual rate. Okay, contract between the bondholder and the company, that during the period, during the duration of the company, during the duration of the bond's life, the company will pay interest at this rate. Okay, so coupon interest rate. In our example, let's say I, let us represent it by I. Small I. So coupon interest rate is 12%. We also need to think about the market interest rate. Remember, just like the face value versus market price. Face value is based on the agreement between the bondholder and the company. Similarly, coupon interest rate is also based on the agreement between the bondholder and the company. But remember, the market interest rate is depending on the demand and supply in the market factor. So that is not agreement. That will fluctuate. That will go up and go down depending on the market condition. Okay, so market interest rate which I indicate by small r. So let's say the market interest rate is actually 10%. Market interest rate is 10%. And one thing you should remember that is very important to recall. This is what I was thinking. I did not tell you that. If the coupon interest rate is more than the market interest rate, normally what will happen? In the market, if the company wants to borrow money, let us think from the perspective of the bondholder. In the market, if the bondholder wants to lend money to someone, they will get 10% interest. But if they buy this bond, they will get 12%. So is it attractive to the bondholder or not attractive to the bondholder? If the bondholders get higher interest from this bond compared to the overall market, then it is good for the bondholder or bad for the bondholder?
Sir, it is good, sir.
Good. So what will happen? There will be higher demand or lower demand for this bond?
High demand.
Higher demand. So the price of the bond will be higher or lower?
It will increase, sir.
Yeah, it will be higher. The price will increase. Yeah, right. So we can actually say that the price should be greater than the official value. So this is what we can see here. Actually, our example is correct. But if we claim that the market price will be 900 or something like that, then probably there must be another reason why the market price is lower. There must be another reason. Probably the bond is very risky, or probably people do not trust this company or something. Maybe some other factors are happening. But given all other things normal, usually if the coupon interest rate is greater than the market interest rate, then the market price of the bond is greater than the face value of the bond. Okay. So these are the underlying theory that you must understand. Calculating in Excel is not sufficient. You have to understand the underlying concept. Otherwise, all the things will be useless. Okay. Now we will do some calculation. If the coupon interest rate, we need another thing. Okay, coupon payment frequency. Frequency in a year. Let's say the coupon is paid, that means it is M, like the time value of money. Number of coupon payment in a year. Let's say it is 12, that means monthly coupon payment. And not only that, we are also going to think about coupon payment frequency in a year is 12, and the maturity of the bond, for how many years the bond will be in life. That means will be outstanding. That means after how many years the company will return this $1,000 to the bondholder. So the maturity of the bond, that we represent by the letter N. Let's say the maturity of the bond is 20 years. In a year. So the maturity of the bond is 20 years. Now, how do we calculate? How do we calculate the cost of the debt? Okay, cost of debt. So for doing that, look very carefully. For doing that, we have to use a function called return. Okay, so cost of debt. Let us give the name capital R D, or yeah, capital R small d, to represent that it is a cost of debt. Okay, D for debt, R for rate. Okay, because we will calculate the cost in percentage term. So in that case, we will use the function. Sorry if I have mistaken the name of the function. Let me check. Oh, rate, not return. Actually, sorry, rate. Okay. Yeah. Anything you want to tell me? Okay, so rate, under the rate, we have, you can see that we have several things to input. And number one is number of period. Remember, in this case, the period is not actually year, because the coupon payment will be done in month. So what we will do, we will always calculate how many months. Okay, that will be helpful for us. So number of period is going to be, if the coupon were paid once in a year, then we will directly input this cell F7. Okay, but remember, in this case, we are not paying the coupon payment once in a year, rather 12 times in a year. So 1 year is equivalent to 12 periods. Okay, this is how we have to think. So the number of period is equal to number of year times the coupon payment frequency in a year. So it is total. Okay. Then PMT. PMT means what is the amount of the payment every period. So in this case, every period is every month. So how much coupon interest will be paid? How much coupon interest will be paid to the bondholder? Do you understand? How much coupon interest will be paid to the bondholder? Do you get it or not?
Yes, sir. Yes,
The
sir.
amount of, yeah, the amount of coupon interest paid to the bondholder every month. Okay, so what we need to do, for calculating the coupon amount, we need to multiply the face value of the bond with the coupon rate. What is the coupon rate? 12%. But because the coupon is paying every month, and normally rates are always annual, so we have to divide it by number of coupon payment in a year. Okay, so that you get the PMT. So ultimately, how much? Can you calculate it? 1000 is the face value times 12% divided by 12. So monthly interest is 1%. So 1% of 1000 is how much? 10. Am I right or wrong? Hello? Can you hear me?
Yes, sir.
Okay. So we got the PMT. So what is the PV? In this case, actually, the PV is the market price, because after selling the bond, the company is getting 1150. The PV is market price. So the company is getting 1150. So this is the PV, and FV is the okay. By the way, we have to incorporate another thing here. The PV is the market price. Okay, let's forget it. We'll do that just one later. Okay, so the PV is the selling price of the bond. Okay, selling price of the bond, because after selling the bond, the company is getting 1150, which is in cell F3. So we are linking F3. Okay, this is the present value. Now, what is future value? Future value means at the end of the bond maturity, how much money the company will have to return to the bondholder. You can see the company will have to return the official value of the bond. So that is going to be, because it is a return, negative sign minus this official value. Okay, minus this official value. Do you understand or not? Why do we use the minus sign here? Because this 1150 is the amount the company will get. Okay, and after 20 years, the company will return 1000. So that is the, if this, the first one is positive, then the next one will be negative, because one is receiving money, another one is paying money. And at the end, type is 0 if it is end of period. So if nothing is said, we'd always assume that it is end of period. So let us put 0 and then bracket close and then enter. So you can see the cost of debt is minus 1%. Actually, because it is a cost, so we are getting minus. But if you personally, I do not like the minus sign. Whenever needed, I will deduct. Okay, so I have put one minus sign before it. And also we have to increase the decimal point to see what is the actual amount. You can see it is 1.014%, but 2 decimal point is sufficient. 1.01% is the cost of debt. Do you understand? Do you understand this? Any question? Any question?
No, sir. No, sir.
Have you understood? Okay. So I'm going to give you about 5 minutes. Will it be enough to do it by yourself?
Yes.
Okay, I'm giving you 5 minutes to practice, and it is open discussion. You can help each other. You can also speak in your own language, no problem. English is also okay. So let us make it a free and frank. So if you are stuck somewhere, you can seek help from your friend. Okay, so I'm giving you 5 minutes, maybe 1 or 2 minutes more if needed. And after that, I will ask you to do it on the screen. Okay, and by the way, I'm also keeping the screen sharing open, and you can see the function here so that you can understand what actually has been done. Okay, is that okay? Hello, is that okay or not?
Yes.
Yes, sir.
Seems that you need money to speak. Anyway, so I will come back after 5 minutes. So now it is your free time for doing this one. Free time, not for any other thing, for doing this one and for discussing among yourself. Okay. Any difficulty? Have you faced any difficulty in doing this one? Can you hear me?
Yes, sir.
Any difficulty? No. Okay, so anybody wants to demonstrate this one? No problem if you have any mistake, we will help you to solve it. Okay, so this is not really an exam or anything like that. Just simply try to show it. Even if you cannot do anything, we will help you. No problem. So who wants to come forward? Rohit, do you want to come forward? Rohit, are you there? Subira? Subira?
Yes, sir.
So do you want to come forward?
Sir, what did you say? Your voice is breaking, sir.
Sorry, I didn't understand.
You called my name. I didn't understand what you were saying. Your voice was breaking for me.
Yeah, I am asking you to do the same thing that I have done. And if you have any problem, we'll help you, no problem. So do you want to share your screen and show how to calculate the cost of debt?
I'll do it later, sir. I'm not yet done, sir. I mean, I told you, right? I'm still fixing the Excel.
Okay, do it. So what about Kartik? Do you want? Kartik? I cannot hear Kartik. Saipurna?
Yes, sir.
So can you do it?
Yes, sir.
Okay, please share your screen. I'm stopping my share and also allowing you to share. Okay, please continue. We can see your screen, but we cannot hear you.
Yes.
Okay, we can hear you now. No problem.
We have to use the rate function. And we have to multiply the maturity of the bond with
Yeah, so actually within the red we have several things. Or number one is NPER, right? So NPER is actually number of periods. So number of period is the actually it should be number of year, but in this case, because we are paying installment, sorry, we are being paid the coupon interest. We are paying the coupon interest to the bondholder every month. Think from the perspective of the company. Okay, so the company is paying interest, coupon interest every month. So ultimately, the number of period in month, it is going to be. Do not continue. No, let me finish what I am explaining. Do not go to the next one. Stick to NPR. Delete that one. Okay. So yeah. So we are right here. We are with N. Please go there and click NPR. Click in the function. Yeah, so that you can see the argument. Okay, so NPR is the number of period. So number of period, if we count month, then in 20 years we will have 20 times 12. This is what we have done. 20 is in cell number I8, and the number of month in a year in cell number I7. So we have multiplied these two, right? So this is how we get the number of period. Okay, then Then Saipurna, please tell us what is the next
Yes,
one.
sir. We'll multiply the maturity of the bond with the coupon payment frequency, and then we'll multiply face value of the bond with
Actually, at first you have to say, now we need the payment per period, amount of
payment
payment per period. Yeah. So how to get it?
face value of the bond multiplied by the coupon interest rate.
And because the coupon interest rate is yearly, but we are paying monthly, so we have to convert it into monthly rate. How to convert it? Divide this one by what?
By 12.
By 12. So click the 12, number of payment in a year. In cell number I7, right? Coupon payment frequency in a year.
Yes, sir.
Do not type, always link the cell. So we got the PMT. Have you got the PMT? Yeah. Then comma.
Then market price per
Yeah,
what
because
was the full
at first tell us that PV
payment
is actually the present value.
payment present.
Yeah. Otherwise, people will not understand. So present value is actually what the company is getting today, which is the market price after selling the bond. Yeah. Then
Now we'll write the face value of the
the company will return the face value at the end of the period, right? So it is going to be positive or negative.
now we'll type 0.
No. At first, the face value, should it be positive or negative?
It should be negative.
Yeah, so put a minus sign before it. Because company will give that money, that money to the bondholder. Okay, and the last thing is what you need to do.
Get the-
Because it is minus, actually we don't want the minus sign because we have already said that this is a cost. So what you can do, we are using the Excel as a tool. We will not be driven by Excel, rather we will drive the Excel. So put a minus sign before it, before the function, before the whole function. Okay, and also increase the decimal point because we don't know it is 1.2% or 1.1%. No, that is fine. You can use just the button, the left one, the left one. Yeah. Another one, yes. Okay. So thank you, Saipurna. Congratulations, and you have really helped the whole class.
Thank
Okay.
you, sir.
I'm very happy. Okay. So now I will extend this one. I will extend this calculation. Can you see my screen?
Yes, sir.
Okay. So actually, we have not done so many other things yet. So for example, I will put it down by inserting certain, so that will not affect the function. The function will remain the same, no problem. So another thing I have not included, you remember that I have said about the three things. One is the coupon interest payment, that has already been taken care of. We have also taken, we have not taken care of the flotation cost and interest tax benefit. So how to include that in the calculation? Okay, so let us write down the flotation cost. Flotation cost as percentage of face value. F, small f, okay? let us bring it one cell further so you can see it. So let's say the flotation cost is 1.5% per 1.5% of the face value of the bond. So if the bond face value is 100, then $1.5. If the face value is 1,000, then it is $150. Sorry, $15. Okay, something like that. So this is the flotation cost. So if you remember what I have said, by flotation cost is the cost of issuing the bond. It is the cost of issuing the bond. Okay, flotation cost is the cost of issuing the bond, right? So how do we actually incorporate this one in our calculation? Remember, you have to think how the flotation cost is actually affecting. The flotation cost is actually affecting the issuing company, because if there were no flotation cost, the company could get 1,150 from each bond. But because there is a flotation cost, ultimately they will not get this entire amount of selling price. From the selling price, they will have to pay the flotation cost, and then they will get. So we have to deduct the flotation cost from the selling price. So let us go to the function and see where is our selling price. You can see it is in the present value, right? Right or wrong? Huh? What is the selling price? This 1150. Is it in the present value or future value? Hello? Present value, right? So present value is in G3, right? So this one should be adjusted. G3. So the company will not get the entire amount of 1150, rather it will get something less. So how much less? G3 minus flotation cost percentage times the face value. Okay, so 1.5% of 1,000 should be deducted, because the company will not get that amount in the flotation cost. Sometimes the flotation cost can also be mentioned in dollar. So in that case, you simply deduct the dollar. That is sufficient. Do you understand? Do you understand or not?
Yes, sir.
So if we press enter, then we can see that the cost is updated. But remember, we cannot see the reflection here because it has a minor effect actually. So if we increase that, look, previously it was 1.014, but now it has become 1.013 due to the flotation cost charges. Do you understand? Okay. So that is one adjustment. And another one is about, as I have told you before, the interest tax benefit. Okay, so to do that, we need the tax rate. So let us write down tax rate. Capital should be, let us just assume it can also be 40% or 50%. The cost is 30%. Can you hear me?
Yes, sir.
Yeah, can you hear me?
Yes, we can hear you.
Yes, sir.
Okay, now can you hear me?
Yes, sir, we can hear.
Okay, so the tax rate is 30%, right? It can be 20%, 30%, whatever, depending on the real picture, but we are just assuming the reality. So the tax rate is 30%. So how do you adjust that? So remember, the adjustment of tax is very simple. For doing that, okay, let me delete so many empty rows. Okay, so this is actually the before tax cost of debt. That means without considering the effect of tax. So before tax cost of debt is this one. So now if we want to calculate the after tax cost of debt, after tax cost of debt, which we will write by RD star, okay, to indicate that the tax has already been incorporated. So after tax cost of debt will always be equal to the before tax cost of debt multiplied by 1 minus tax rate. 1 minus tax rate. Okay, have you understood? So after tax cost of debt is always equal to the before tax cost of debt minus, before tax cost of debt times 1 minus tax rate. So you can see it is 0.71%. It is 0.71%. 0.71%. One thing you must remember, that when we calculate the before tax cost of debt, we have considered month as a standard period. Am I right or wrong? Hello?
Yes, sir. Yes,
Okay,
sir.
but the convention is the rate must always be mentioned on an annual basis. So we have actually got it, the monthly cost of debt. So what we will do, at the end we will multiply it with number of period in a year. Okay, so in that case it is 12. Okay, now we will get the correct figure. So remember that we need several adjustments when we calculate the cost of debt. So ultimately, on an annual basis, the after-tax cost of debt is 8.51%. Okay, is that clear to you? Any question? If you have any question, you can ask me. So after tax cost of debt is very much clear, 1 minus tax rate, but before tax cost of debt, you can see several adjustments are needed. One is ultimately at the end, you have to convert it on an annual basis, and within the function, you have to be careful about what is actually your period to be considered in the calculation, within the calculation. So within the calculation, it can be monthly, it can be quarterly, it can be semi-annual, whatever is the case, do it accordingly. And at the end of the function, again convert it into annual basis. Okay, so this is how you can actually do it. So for understanding this adjustment, I'm giving you another 5 minutes time for your practice and discussion among yourselves. Okay, and after 5 minutes, I will come back and ask some of you to come forward and show it on the on your screen. Okay, so now it is 11:10. I'll come back at 11:15. I'm actually here, no problem, but we will see your final calculation at 11:15. Thank you. Okay. So any question? Can you hear me? So who wants to come forward and show me the remaining adjustment? Anybody? Voluntarily? Khushi Rawal? Pradeep, do you want to show? Hello, can you
Sir?
hear me or not? Yeah. Pradeep, do you want to
Sir,
show?
sorry, sir, there's a network issue here. I can't share my screen.
You have network issue, okay. Omar,
Yes, I'm logging through.
Omar,
Yes, sir.
can you show?
Yes, sir, I did, but I couldn't do the adjustment.
So
Fine.
can you try now?
Yes, sir,
Maybe
I'll share.
we can help while you try.
Yes, sir, I'll share the screen.
Okay, okay. So I'm stopping my screen. Now share your screen.
Yes, sir. I didn't get it, sir, how you got here 12%.
Okay, no problem. No problem. So go to the, can you increase the, can you a bit zoom in? Yeah, okay, 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 okay. So at first, although I have done it at last, but you can do it at first, no problem. Because this 1% is actually a monthly rate. So what you can do, you can convert it into annual. How can you do that? By multiplying it with what?
This, sir.
Yeah, this one. This one is now monthly, right?
Yeah,
So we want it to be annual. So how
yeah.
can you make it annual?
Multiply it with 12.
By multiplying 12. Okay. So click here. Yeah. Start. That means multiplication. Then where is 12? No, 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 no. Do not type the value. Always go to, because you already have that coupon
Yeah.
payment frequency in here. Yeah. Click that one. Now enter. Now you get. But another thing is, because you are not showing the decimal, so it could be misleading, because 0.1% is also huge amount. Okay, so click this cell again and then increase the decimal point. Increase the decimal point. Okay, click on the, no, not here, go to the ribbon up above. Yeah, right, go to the right, not that much right. Left, again left. Yeah, here. Yeah, that button, that below. Yeah, that one, not the left one. Yes. Okay, good. So that this is how you get the annual cost of debt. And this is actually before tax cost of debt. So write down before tax, before cost of debt. Okay. Now you want to calculate after tax. So what will be the after tax one? Go to the after tax, click the cell. You have already done it, right? D16 times 1 minus what is D10 tax rate. Okay, you're already done. But now reduce the decimal, because it looks odd if you have so many decimal points. It is not necessary. Keep 2 decimal point. Wonderful. Okay, that's very nice. Omar has done it very nicely. Thank you very much. Okay.
Thank you, sir.
Yeah. So now you are going to get a break, and after the break, we will discuss about cost of equity. After the break, we will discuss about cost of equity. Okay. So when we can come back, we will come back at 11:40. Okay. Is that okay?
Yes, sir.
Hello, is that okay? Yeah, okay. We'll come back at 11:40. Can you hear me?
Yes, sir.
Okay, great. So we have already discussed about, can you see the spreadsheet?
Yes, sir.
Can you see the spreadsheet, the Excel file?
Yes, sir.
Okay. So we have already calculated the cost of debt, right? So let me write it down here. Cost of debt. Now we will learn how to calculate the cost of equity. Cost of equity. So if you want to calculate the cost of equity, we have several things to consider. Actually, there are several models. Okay, let me show you the models first. Cost of equity models. Can you see my notebook?
Yes, sir.
Okay. So now I'm going to so cost of equity. If you want to calculate the cost of equity, actually, the formula, the formula that you must use is the current price of the equity or share in the market, given that the dividend grows at a constant rate. So let me write down the formula first, then I will explain. So it will be equal to next year dividend divided by RS minus G. So if you rearrange this one, then it will be, so in time below money, we have discussed about growing perpetuity. Do you remember? Growing. Anybody of you can remember or not? Growing perpetuity. So in case of growing perpetuity, what happens? Let me try to help you to remember. So these are the years. So what happened? The cash flow increases at a constant rate, 1 plus G, CF times 1 plus G whole square, and so on. This is how it continues forever. So in that case, the present value of perpetuity is equals to CF1 divided by R minus constant growth rate. So this was the formula. And this is the formula of present value of growing perpetuity. Probably I have not shown it in written form, but I have shown it in the Excel file. Okay. So we are going to use that formula actually. So using that formula, the present price of the stock should be like this. So if you rearrange this one, then it becomes, if you rearrange this one, how to rearrange? P0 RS minus P0 G is equals to D1. So from here we get P0 RS is equals to D1 plus P0 G. So from here RS will be equal to D1 divided by P0 plus G. If you divide both by P0, then what happened? D1 divided by P0, and here P0 will be cancelled out and you will get G. So this is the expression that we'll be using to estimate the cost of equity. So this is the mathematical background, but we will learn it to do it in Excel. So from here, what does it mean? What are the notations are standing what the notations are standing for. RS is equals to cost of, sorry. I need to adjust this one. RS is actually equal to required rate of return. Required rate of return on equity, then D1 equals next year dividend, next year or year one dividend. Dividend is the share of profit that is given to the shareholders. P0 is equals to current share price. Okay, and G is equals to constant growth rate of dividend. Constant growth rate of dividend. Now, this is the return. RS is the return for the shareholder. So when the shareholder gets some return, that must be given by the company. So this is ultimately it becomes the cost. Okay, so let me change the color of my pen, and now let us write the expression for cost. So the cost of equity, represented by RE, okay, should be equal to the same thing, because this is the return shareholders are getting, and the shareholders are getting the return from the company, not from any other provider, right? It must be from the company. Okay, so if this is the case, then cost of equity will also be this one with some difference. Do you remember flotation cost? The flotation cost will come into account, because whenever the company is issuing share, like bond, the company will also need to incur some cost. Okay, cost of documentation, legal cost, underwriter commission, and all this thing, marketing. Okay, so we will bring in the flotation cost in the selling price, because the company will not get the entire amount of selling price. The company will get selling price minus the flotation cost. So cost of equity is equals to next year dividend divided by, this is D, okay, next year dividend divided by P0 minus flotation cost, okay, plus G. This is the expression for cost of equity. Okay, this is one way of calculating cost of equity. Okay, this is the one method. This is one method of calculating cost of equity. There is another method, cost of equity, RE is equals to RF plus RM minus RF times beta E. So what these things mean actually? These things mean RE, we know this is the cost of equity. Then RF is the risk-free rate of return, usually the treasury bill rate. Okay, can you see my writing?
Yes, sir.
RM is the market rate of return. That means if anyone invests in all the share of the market proportionately, then what will be the overall return, the average return of the market? This is the market return. So stock market is risky. So if we look at this one, this is the difference between the market return and risk-free return. Government treasury bill is risk-free because government will always pay you the money. So we can consider that government treasury bill does not have any risk. On the other hand, Market, the share market is very risky. So what is the difference of return between these two? Times beta, beta of the share. Okay, so what is beta? Beta E is the systematic risk of share E. Okay, E share, the systematic risk of share E. Okay, so these things are given. Of course, you can learn how to estimate beta, how to estimate and all this thing. But these are beyond the scope of this course, because that does the length of the course does not allow us to incorporate all these things. So conceptually, what I'm just explaining to you. Now, if you go back to the, so that is method 2, actually, that is the method 2 of calculating cost of equity. So what normally we do, we use both methods and take the average of these two, because the cost of equity calculated using method 1 might differ from cost of equity calculated using method 2. So in that case, definitely we should not take only one. We should take the average of both, unless we can justify one method to be superior over another. Okay, so now let us write down the information. Have you understood? So let me write down the current dividend. So what do we mean by current dividend? By current dividend, we mean the immediately past dividend. So what was the dividend that was paid immediately in the last year? So we call it D0. Okay, D0, let's say D0 was $12. D0 was $12. Now, constant growth rate of dividend, G equals, let's say 3%. The dividend will grow at the rate of 3%. Now, after that, the current market price of share, P0. 0 means current, okay, present market price. Let's say the current market price is 135. Okay, and from here we can use the method 1 of calculating the cost of equity. So let's take RE for cost of equity. So RE should be equal to, as I have said, under method 1, we can see D1 divided by P0 minus flotation cost plus G. So I forgot to give the information about flotation cost. Let's say the flotation cost per share. So in this case, the amount is given in dollar. Let's say the flotation cost is just $2 per share. So you can see the formula is D1 divided by price minus flotation cost plus G. So it is going to be very easy. D1 is how much? D1 is, remember, even if it is easy, but you have to be very clear. We are given D0, but we need D1. So what will be D1? D1 is actually equals to D0 times 1 plus G. Right or wrong? So So how do we get this D1? Is D1. D1 equals, because it is increasing at the rate of G, so it will be D0 times 1 plus G. Then we get the D1. So you have to be very careful. Sometimes D0 is given, sometimes D1 is given. If D0 is given, you need to calculate. So for calculating D1, we are taking D0 times 1 plus constant growth rate. Okay, so we got D1 now. So the formula is D1 divided by P0. So what is P0? Actually not P0 alone, P0 minus flotation cost. So I have to use bracket P0 minus flotation cost. Okay, and I would like to be in a safer side. So I would use another bracket for the whole numerator. Okay, so this is D1 divided by P0, this one minus flotation cost. Flotation cost is $2. Plus, so this is one expression, plus constant growth rate. What is the constant growth rate? This 3% is the constant growth rate. Okay, so after doing this one, then we press enter and we find that the cost of equity is 12.29%. Sometimes you get decimal, sometimes you get fraction. So for example, if you get it in in just number, in just number format, you can easily convert it into percentage and take 2 decimal point. Okay, so this is method 1 of calculating the cost of equity. Now let us use method 2 of calculating the cost of equity. Cost of equity. Are you listening to me?
Yes, sir.
Okay, so the method 2 is very simple. In that case, you need some information, but we don't have those yet. So I'm just inserting some rows to accommodate those information. So you know that we need the treasury bill rate. RF. Okay, let's say the treasury bill rate is simply 4%. Normally government security rate is not very high. Okay, market return RM, let's say it is 12%. Beta of the share of this company, beta, EB for beta, although it is a Greek letter, I will use B. Let's say that is 1.23, and it is not percentage. Be careful, sometimes Excel automatically consider it as a percentage. So let us consider it as general, and let us type it again, 1.23. Otherwise it will be a misleading information. Okay, so if we get all these, then we can easily calculate the cost of equity. So the cost of equity will be equal to, as you know, it will be the risk-free rate of return plus RM minus RF, that is this one minus this one, times beta. Now again we got percentage, that is fine, but decimal point. So now, because 2 methods are giving 2 different cost of equity, so we can calculate the, ultimately we take the average of these 2, cost of equity RE equals, so here we take the average between these 2, so equals average of this one and this one. So 13.07%. So this is how you can calculate the cost of equity. For cost of equity, you don't need to calculate after tax. After tax is only applicable for cost of debt. Okay, so I'm giving you 5 minutes time to practice the cost of equity, and this one is easy, so I'm not pointing here, I'm just pointing here. This one is relatively complex, and this one is also easy. Okay, so I'm giving you 5 minutes time to do it, and after that one of you will come forward and help the class to understand and do it again. Okay, any question before that? No. Okay, so we'll come back after 5 minutes. So I'm back. Who can come forward and show the screen? Any volunteer today? Akshara, are you interested? Akshara, at least respond to me.
Sir, my Excel isn't working, sir.
That's very sad. Anyway, Navia,
Yes, sir.
can you come forward and help all of us to see it again, the calculation of cost of equity? We're ready to help you, no problem.
Sure, sir. Sir, is my screen visible?
Yeah, please continue, no problem.
So for the method one,
Also say what you are doing, otherwise people will not understand what you are doing actually.
and then I'm adding a constant growth rate of the dividend. And then for method two, I'm gonna multiply T bill date with market return, and then gonna subtract and then multiply with beta of the share. That's it, sir.
Now calculation, that means the average, take the average of the two methods.
Should I divide it?
Something is wrong because your cost of equity in first method is 12 point something and second one is 13 point something. So average must be in between these two, right? So go to the formula and see what is wrong. Let's see if you can identify. Not this one, the last one, the average one. Yeah, there is something wrong. Actually, when you divide by 2, okay, do it again. Okay, let me help you. In fact, what Excel does is Excel will do the multiplication, division, all this thing before doing addition, subtraction. Okay, So that is the, yeah, that is the hint I'm giving. Okay, good. That's good. Thank you. And
Thank
you
you, sir.
have also helped us to review the way the formula works. Okay, thank you very much. Well, we have discussed about the cost of debt and cost of equity, but remember that there are two types of equities. There are two types of equities. One is the common equity and another one is the preferred equity. So let me show you the difference between these two. So there are two types of equities. One is the common equity. That we have just covered. And the other type of equity is called preferred equity. So what's the difference actually? In case of common equity, the dividend is variable. Okay, and in case of preferred equity, the dividend is fixed. So if we think about common equity, let us look at the timeline. 0, 1, 2, 3, 4, 5. We don't know how much dividend will be there in different years. It can be different in amount depending on the management decision. $10, $12, $9, $13, or sometimes it will be increasing constantly. 10 times 1 plus G, 10 times 1 plus G square, something like that. But in case of common equity, the dividend is fixed by contract. Okay. Sorry, in case of preferred equity. Preferred equity, every year, the dividend is fixed. If it is 12, it will always be 12. And it does not have many maturity, so it will continue forever. So it is called perpetuity, something like that. So cost of preferred equity, if you want to calculate the cost of preferred equity separately, cost of preferred equity, RP, is very simple. The constant amount of dividend divided by the price, market price of the preferred stock. Market price of the preferred stock. So we have to know how much is the price. So in terms of formula, you can write this one. The dividend of the preferred equity divided by market price of the preferred equity, something like that. So let us apply it in Excel. So now let us write cost of common equity. And now we're going to write cost of preferred equity. Preferred equity. So we don't need much information. We just need the market price of the preferred share Let's say the market price is 150. And the preferred face value of the preferred share, like bond, it also has a face value. So PF for face value. Let's say the face value is 100. Rate of dividend. This is not interest rate, but like interest. Huh? So rate of dividend. How do I express it? Okay, IP. That means the rate of dividend of the preferred stock. Let's say the dividend rate is 13%. So the dividend will be calculated based on the face value. So 13% times 100. This will be the calculation. And not only that, flotation cost. Every share or bond need flotation cost to issue. Let's say the flotation cost is $2.5. Now you can easily calculate the cost of preferred equity. So let us call it RP equals. So in the numerator, as you know, it will be the dividend. So how do we get the dividend amount? The dividend amount is the face value times rate of dividend. Okay, this is the numerator, divided by current market price. But actually what you need to take current market price minus flotation cost, like any other, because the company will get that get the amount less the flotation cost. Okay, so divided by current market price, within bracket definitely, current market price minus the flotation cost. So you get the cost of preferred equity. Let us convert it into percentage and increase the decimal point by 2 decimal points. This is how you can calculate the cost of preferred equity. So let us correct, because we have two types of equity. So in all equity, we will call it common equity. Okay. So this is how you can actually calculate the cost of preferred equity. I'm not going to give you time for this one because this one is easier. If you can do the earlier one, you can do it all as well. Now the thing is, we have got 3 cost of capital, because probably our company has collected capital from debt as well as from common equity as well as from preferred equity. So if we want to get an aggregate cost of capital, overall cost of capital, then how to calculate that? So let me give you another section. Overall cost of capital. So normally, if you want the overall measure, normally we take the average. But the problem is, okay, before talking about the problem, let me tell you when you can take the average. You can take the average only if your business, the capital of your business has been collected in equal proportion from these 3 sources. Okay, but it might not be the case. That can be incidentally true for any business organization, that they have collected exactly the same amount from debt, same amount from common equity, same amount from preferred equity. But that is not the case in most businesses. Okay, they collect a certain amount different from other sources. Okay, from one source. So what do we need to do? We should not take the simple average. We should rather take the weighted average. So to take the weighted average, we at first need to know how much capital is raised from debt, how much capital is raised from common equity, and how much capital is raised from preferred equity. So for that purpose, let us create a table. So source of capital. We have three sources. One is the debt, another one is the common equity, and the other one is the preferred equity.
Look,
Yes. Now, amount of capital. So let's say your company has raised $100,000 from debt, 300,000 from common equity, and 150,000 from preferred equity. So we can find the total, or we can write all. So what will be the total? Equals sum of these three. Okay, this is the total capital. Then again, weight of capital. Source. Because you know we have three sources, so what we will do, we will find the proportion, the percentage of the total capital taken from debt, percentage of the total capital taken from common equity, percentage of total capital taken from preferred equity. So that is called weight of capital source. So if for example here the company has collected most of its money from capital from common equity, so common equity should have higher weight in proportion to its percentage taken from common equity. So how do you calculate that? Equals this one divided by the total, and this must be locked. How do you lock? I think you remember dollar, and we can convert it into percentage with 2 decimal point, and we can copy. Okay, so we have got that out of the 100% of capital, 54.55% has been taken from common equity, 27.27% has been taken from preferred equity, and 18.18% has been taken from debt. Given this weight of capital source, now what we can do, we can bring in the figures here. The component cost of capital. Component means debt is one component, equity is one component, and common equity is one component, preferred equity is another component. So let us write down component, or we can simply write cost of capital. So cost of debt is equals to this one. We must take the after tax, no doubt about that. Then cost of common equity is this one, and cost of preferred equity is this one. So the total will be sum. Let us check from H46 to H48. Okay, this is the cost of capital. But actually we should not take the total. what we should take is, let us delete it because we cannot take the total. It should be average, and average should not be simple average, it should be weighted average. So how to get that? So what should we write? WEIGHT, weighted cost of capital. So it is going to be equals the cost of capital, cost of debt multiplied by percentage taken from debt. Percentage of total capital taken from debt. And this one is our weighted cost of debt. Now weighted, same calculation if we copy down, weighted cost of common equity, weighted cost of preferred equity. Now if we take the sum, now that will be the weighted average cost of capital. Sum of these three. So this is the weighted average cost of capital. Okay. Weighted average cost of capital, or WACC. Weighted average cost of capital, or WACC, is 11.8%. So we can say that this 11.8% is the ultimate aggregate measure of cost of capital of this company. Do you understand my point? If you have any question, you can ask me. Any question? No question. Okay. So now I'm going to give you about 5 to 7 minutes time to practice this one, and I will come back and request some of you to come forward and show. Maybe some of you have already done this part, so show the preferred equity component and also the overall cost of capital, if anybody can. Okay, so practice it yourself and also open discussion for 5 minutes. Okay, is that okay or not? Hello?
Yes, sir.
Okay, please continue. Okay. Who can come forward voluntarily? Vaishnavi? Yeah, Vaishnavi, do you want to show the calculation?
Sir, my Excel
Okay. Jivan Sai? Jivan Sai? Pragati Subha? Pragati Subha? Nobody is responding, or I have some problem in my speaker. I don't know.
No, sir, you're audible.
Khushi Rawal? Ullash Mente? Actually, do not treat it like you have to do it rightly, or you have to be able to do it. If you start, I'm going to help you. We are going to help you, actually. Yeah? So do not take it seriously that sir has asked me to show something and I have to do it perfectly. If you can do it really perfectly, then you don't need to attend this class, isn't it? You don't need to be a student. You become professional by born. Okay, so we will not be able to do it. That is normal. And the reason I normally ask the student to show it is the other students also look at what kind of difficulty you might find. For example, in the previous example, one student was having difficulty using brackets, so that can help the students. I might not make that mistake. So people will normally learn from the mistake. And this is why I encourage you to come forward and show, whatever you can. If you cannot, no problem. We are here to help you. So I'm not calling any name any further. If anybody comes forward voluntarily, then it's fine. Otherwise, we will conclude the session. Okay, I assume that nobody will come forward. So in the next class, I am going to send the case study 2 document to Omar Kamkani, who is the class representative. Omar, can you hear me? Omar, can you hear me?
Sir, I think he have an internet issue. Do you want me to convey any message to him?
Okay, anyway, any other class representative here? Okay, no problem. I have already told him. So I will give the case study document in the WhatsApp group as well. So you will not find any difficulty. And in addition to that, I will also send to Omar, as he is the class representative. Then you will get it by today. By today means by within 1 hour. Okay, and you will have to start working. That one is very easy, but the next one is not going to be easy. So take it as an opportunity and do it perfectly so that you get higher marks here. That might help you to compensate if you by chance perform worse in any other case. Okay, so the
Okay.
next one is going to be quite comprehensive. So this one is the easiest one among the three. So take the opportunity. do it very nicely and also come forward and show your calculation, all this thing. So that is all. And in the next class, we will be discussing about capital budgeting. Okay. Then probably our syllabus will be almost done. And then we will have a comprehensive case study. Right. So after this cost of capital, then we will go for capital budgeting techniques. Okay. So that's all for today. See you students in the next class. Thank you very much.
Thank you.
Yes, sir.
Yeah.